Hello, I'm Sean Richards of Not a Yes Man's Economics. What I wanted to talk to you about today is interest rates and the path for them. Why does that matter? Well, in terms of economics, this feeds into the economy via things like mortgage rates. Those thinking of remortgaging, buying a house. This is a big deal. Similarly for businesses if they're thinking of borrowing. So it feeds through into the economy in a variety of ways. Why is that on my mind? Well, this has been a constant theme in 2019 so far, of central banks heading us towards the fact that having started promising us that they were going to raise interest rates, they've shuffled back and now they're saying more and more that they're going to cut them. Some have been left behind by this. For example, my own country, the UK, meets tomorrow and the Bank of England there has a very difficult task of having told people for ages it's going to raise interest rates, somehow shuffling towards cuts. This was particularly evident yesterday in Europe. The European Central Bank takes its summer holidays, if you like, at a place, Sintra, in Portugal. Its president, Mario Draghi, spoke, and some of it was standard stuff about the euro, how great it was, this sort of thing. Then at the end, it came with quite a kicker, which talked about inflation, and if it's too low, the European Central Bank will act again. Now this matters across a range of things here because, in case you're not aware, it has a deposit rate of minus 0.4%. So for example, there was supposed to be a phase where it got out of negative interest rates. It's now looking very, very likely that it won't, and it may cut again next. This spiraled across in Europe across a range of things. For example, Germany has been paid to borrow for a while. For me to explain what I mean by that is, if you take its benchmark 10-year bond yield, that went negative a month or two ago. Yesterday, that went past minus 0.3%. So Germany, across a range of maturities, is being paid to borrow. Other countries joined the party, albeit briefly. France, for example, saw its bond yield briefly go negative. In general terms, and now be zero. So it's not paying to borrow. So this is an impact on governments and how then they'll behave. But these sort of things, as we look forwards, all come round to the ordinary person to some extent as well. Obviously, the banks will take their cut, but we could see lower mortgage rates across Europe. That would be a change. Later today, the US Federal Reserve meets, and things have changed there in two respects. One is a response in the international sense to what looks like it's coming out of Europe. That puts downward pressure on the Fed. And then we see another situation where President Trump has been pressurising the Fed to move for about 6 months now. So that creates a situation whereby I expect some sort of change from them. I'm not expecting a change today. Could happen, but I think that that's unlikely. What they'll be doing is guiding people towards what they expect to do, i.e. cut later on this year. I think that's the pattern that we're now heading for. We may see some manoeuvring round about the issue of what you might call quantitative tightening, whereby they've been selling off some of the bonds that they bought. So as you can see, this is something of a change. If you've been listening to me, this should be no great surprise because we've been heading in this direction all year. But some places, I say, are still talking about interest rate rises. Some, unbelievably, were talking of interest rate rises in Europe earlier this year. So the pattern, if you're looking at things and you're thinking of going into something like mortgages, this is not advice, you've got to be very careful about saying like that, but it looks like they're going to get cheaper. Same for businesses. So in itself, this is good news. You can borrow more cheaply. The undercut, of course, is that it comes for a bad reason because they're worried about the world economy. Thank you.